Be your conference operator today. I would like to welcome everyone to Athene's Fixed Income Investor Call. At this time, all participants have been placed in a listen-only mode, and the floor will be open for questions following the presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. I'd now like to turn the call over to Jeannie Hess, Vice President of External Relations at Athene. Please go ahead.
Thanks, Melissa, and welcome everyone. We must remind you that today's call may include forward-looking statements and projections which do not guarantee future events or performance. We do not undertake any duty to revise or update such statements to reflect new information, subsequent events, or changes in strategy. Please refer to Athene and Apollo's most recent quarterly and annual reports and other SEC filings for a discussion of the factors that could cause actual results to differ materially from those expressed or implied. We will be discussing certain non-GAAP measures on this call, which we believe are relevant in assessing the financial performance of the business, and you'll find reconciliations of these metrics within our materials available at ir.athene.com. Additional information on the business and this quarter's results are available in the latest fixed income investor presentation posted this morning to our IR site. There you will also find our latest corporate structure deck, which provides detailed disclosures on our Bermuda operations. Joining me today are Grant Kvalheim, CEO, Jim Belardi, Executive Chairman and CIO, and L.J. Tongi, Chief Financial Officer. During today's discussion, Grant will cover our organic growth engine, commitment to transparency, and the opportunity ahead. Jim will take us through the asset side of the balance sheet, including year-to-date deployment, and L.J. will then discuss financials and capital. With that, I will now turn the call over to Grant.
Thanks, Jeannie, and good morning, everyone. The second quarter for Athene was all about momentum. We generated $22 billion of total inflows, underwritten at target returns, while delivering record spread-related earnings. The $22 billion of organic volumes in the quarter were driven by activity across retail, flow reinsurance, funding agreements, and new markets. In retail, inflows totaled more than $12 billion in the quarter, the second highest to date, reflecting strong demand for our retirement solutions. Across all product categories, fixed indexed annuities, MYGAs, and RILAs, we saw higher volumes quarter over quarter, with RILA sales reaching a new high with nearly $1 billion in sales. On a year-to-date basis, RILA volumes totaled $1.5 billion, already exceeding total volumes written in 2025, as we continue to envision significant upside in this product category. In the funding agreement channel, we delivered almost $6 billion of volumes in the second quarter, reflecting issuances across our FABR and FABN programs. We did our first syndicated FABN issuance since last September, given the material improvement in our credit spreads. Inflows from flow reinsurance were the second highest on record at almost $4 billion, which were primarily driven by strong volumes from U.S. clients, as well as a new product with a new APAC client. Asia remains a target market for Athene, given the favorable demographics and the need for retirement savings. Earlier this summer, we announced that Larrick Hall joined the company as head of Athene Japan. His strong track record of building retirement businesses and meaningful experience leading large-scale insurance platforms in the Japanese market makes him exceptionally well-suited to expand Athene's footprint locally. Since our first transaction with Japanese cedents in 2020, we have reinsured more than $20 billion in assets across 8 transactions, helping insurers manage risk, operate with greater efficiency, and innovate in service of policyholders. Overall, we are pleased with the strong momentum at mid-year, and we're on pace to achieve 10% spread-related earnings growth, assuming an 11% alts return, and our full-year new business volumes target of $85 billion. The new business we have written year to date reflects strong demand for guaranteed income products and our ability to help meet the needs of retirees and the institutions that serve them. As I have said before, we are in the trust business. When individuals invest their hard-earned money with us, they make a long-term commitment. We take very seriously that our first obligation is to meet the promises that we've made to policyholders, and to do so in a clear and transparent manner. This is why we lead in areas like disclosure, and we encourage the industry to do the same. This is also why we believe it is important for the industry to operate on a level playing field. Collectively, it is our job to maintain and preserve trust. For this reason, we are encouraged by the NAIC's recent proposal that takes meaningful steps to address offshore regulatory arbitrage. In this proposal, NAIC leadership has directed the Life RBC Working Group to develop a capital charge for reserves ceded outside of reciprocal jurisdictions, and to modify the life formula to account for business ceded to reinsurers with lower financial strength ratings. We are also seeing and encouraged by the increased focus by governments, particularly the Caymans, to cleaning things up. We are unwavering in our desire to see the industry operate on a level playing field. Until then, we will continue to make the distinctions between what we do and how others in the industry operate unmistakable. In addition to raising the bar for disclosure and calling for an end to regulatory and capital arbitrage, we remain committed to achieving a ratings upgrade to AA. As an industry, we have an opportunity to solve the societal need for guaranteed income in retirement. Populations are aging. Annuities offer the unique ability to provide guaranteed income for life. Not for 10 years, not for 20 years, but for as long as you live. And the industry has not gotten its rightful share. Part of that is because these products can be overly complex, and the benefit annuities provide, including principal protection and tax deferral, are not broadly understood. When compared to CDs, for an example, annuities offer meaningfully better returns, better liquidity, principal protection, and tax deferral. We believe there's a big opportunity to unlock demand across the industry by improving the customer experience for retirees and financial advisors by making the product set easier to understand and access. One way we are pursuing this is by modernizing the buying process to make it simpler. At Athene, nearly 90% of annuity applications are processed electronically, and the ones in good order are issued the same day, dramatically improving speed of issuance. We see a future where investments in technology will reduce the time between application and issue to a matter of minutes. With that, I'll hand it over to Jim.
Thanks, Grant, and hello, everyone. I'd like to offer perspective on what we're seeing in terms of asset deployment opportunities across our portfolio, as well as how we think about affiliate assets. In the first half of the year, we invested nearly $70 billion. Within this activity, there was more than $40 billion of proprietary investment-grade credit directly originated by Apollo. These assets came with an attractive excess spread of approximately 180 basis points above comparably rated public corporate benchmarks, driving our ability to produce profitable growth. The most attractive opportunities for deployment year to date were in asset-backed securities, mortgage loans, and corporates. First, asset-backed purchases accounted for 30% of the total and included $8.5 billion across 3 vintages of AMAPs. In comparison to CLOs, the AMAP's construction has a thicker equity tranche while still being approximately 85% investment grade, And while CLOs are almost entirely comprised of single B broadly syndicated loans, the underlying collateral in AMAPs is significantly more diverse and approximately 50% investment grade. The most recent AMAPs issuance came to market with 4 public investment grade ratings from Moody's, S&P, Fitch, and KBRA. In addition, we converted the private letter ratings on 2 earlier issues to public. In its June 30th report on AMAPs, Moody's highlighted diversification as a key credit strength. The report also noted the identified underlying portfolio's largest single obligor is expected to comprise less than 5% of total assets, and the largest industry sector around 13%. According to Moody's, this broad diversification mitigates idiosyncratic risk. With each AMAPs vintage, we invest less and syndicate more. We expect our AMAPs holdings to continue to increase over the coming months and replace what we would have otherwise invested in CLOs on the margin. CLOs have become commoditized, and over the last 18 months, Athene has significantly reduced its allocation by nearly 40% on a gross basis. Mortgage loans represented 30% of year-to-date deployment, with a higher allocation to CMLs. That included $9 billion of loan purchased from Apollo Commercial Real Estate Finance, or ARI. As a reminder, this transaction was a unique opportunity to source commercial loans that we know very well, with attractive yields and conservative LTVs. All in, these assets offer excess spread in size for many credits we already own pieces of or know versus new issue CMLs today. Finally, in addition to mortgage loans and ABS, we also purchased corporates and treasuries, which represented 40% of our total, consistent with our conservative posture. The origination pipeline for the remainder of the year is robust and reflects the wave of investment in the industrial renaissance that needs to be financed. Hyperscalers and tech issuers are accessing both the public and private investment-grade credit markets in scale. And through our alignment with Apollo, we have access to the full spectrum. When evaluating opportunities in AI infrastructure financing, Athene invests primarily in secured investment-grade debt. The underlying credit exposure is predominantly to hyperscaler and semiconductor companies, which are large investment-grade businesses with established track records of cash flow generation that predate the current AI cycle. Athene incorporates counterparty and other risk limits when evaluating debt used to finance AI infrastructure, recognizing that counterparties and investment structures across the sector present distinct risk profiles. This includes considerations for issuer concentration across the sector, as well as construction and operational risks. As Grant mentioned earlier, industry-leading disclosure is one of the ways we differentiate ourselves in the marketplace. Our dedicated presentation on affiliate or related party assets was first published a year ago, last August, and updated in May. We remain the only company to disclose this level of detail on the topic. While the labels sound technical, the concept is simple. In most cases, the labels apply because Apollo manages a legal entity that issued investment-grade debt secured by unaffiliated assets. Apollo does not own the underlying business, it manages the structure, which is what makes these assets secured. Asset-backed financing, which is extended to investment-grade companies, provides us with additional control over the sourcing, selection, documentation, and servicing. As of year-end, 13% or $49 billion of Athene's gross invested assets had the declassification of related party. 60% is secured debt issued by an entity managed by Apollo, but with unaffiliated underlying collateral or borrowers. These assets are primarily investment grade, typically with significant third-party ownership that validates the attractiveness of the assets. An example of this is AMAPS. 35% is equity in an affiliate or an Apollo fund with significant third-party participation. The majority of this category is Apollo-aligned alternatives, AAA, a pooled investment vehicle with 43% third-party ownership. Importantly, historical impairments on Athene's related party assets have been de minimis at 2 basis points over the last 5 years, compared to 10 basis points for all other assets. These are some of our favorite assets because we have deeper perspective on the underwriting and relative value. I'll now turn it over to LJ to cover our strong financial results and capital position.
Thank you, Jim, and good morning, everyone. We delivered another strong quarter of financial results that reflect the momentum in the business and our ability to originate new organic volumes in line with our long-term ROE targets and historical averages. Looking ahead to the second half, we expect to continue writing the good business we want and are maintaining our full-year target of 10% SRE growth, assuming an 11% ALTS return. Turning to our financial performance. Strong net organic growth drove spread-related earnings to $877 million in the second quarter, a new record. Second quarter net spread improved to 114 basis points from the 97 basis points in the first quarter. SRE included a 9% return on Athene's ALTS portfolio, a sequential quarter improvement due to strong performance by the AAA, along with appreciation at Athora. Going forward, we expect further gains in organic growth and returns at Athora as the peak integration progresses and the asset portfolio is optimized. When considering our 11% return expectation on the alternatives portfolio, second quarter net spread would have been 10 basis points higher. Adjusting for this, the net spread is in line with the 120 to 125 basis points outlook that we provided for the year. On a core basis, the net spread improvement resulted from a rising fixed income yield as we continue to source attractive investment-grade assets, including the commercial mortgage portfolio we acquired from ARI, as Jim mentioned earlier, along with lower expenses and interest costs. Partially offsetting these positives was the lumpy asset roll-off from the previously announced Intel repayment, along with the normal course rise in cost of funds as the portfolio continues seasoning into the prevailing rate environment. Importantly, we recognize a gross realized gain of almost $700 million within GAAP results, or about $400 million net of NCI and taxes due to the Intel repayment, which also benefited capital. Our capital position remained robust as of June 30th, with $37 billion of gross regulatory capital. Total deployable capital was $6.1 billion, which includes excess equity capital, untapped leverage capacity, and available undrawn capital at ATHPrA. Our sidecars are key to our business model, and we plan to continue to use this on-demand, long-term equity capital provided by third-party investors as an efficient way to fund growth while maintaining balance sheet strength. Excess equity capital was $1.4 billion as of June 30th, compared to $1.7 billion as of March 31st. As Grant mentioned earlier, retail volumes of $12 billion represented the second highest quarter on record, and we allocated the capital required to support it. Last week, we enhanced our balance sheet by successfully raising $1 billion of 10-year senior debt at 155 basis points over treasuries to help fund future growth. We upsized from initial expectations given strong demand from a high-quality order book. We intend to continue accessing the capital markets to help fund or pre-fund growth while observing the upper limit of our adjusted leverage ratio. In addition to our strong capital position, we had nearly $80 billion of available liquidity as of June 30th, which includes cash and equivalents, highly liquid assets, committed repo lines, the holding company credit facility, as well as the liquidity facility, plus untapped capacity at the FHLB. We are one of the few companies that have amassed about $35 billion in cash, treasuries, and agencies, positioning us flexibly to be opportunistic amid a tight market backdrop. As Jeannie mentioned earlier, we recently published the fourth annual update of our corporate structure deck. which provide detailed disclosures on where capital, assets, and liabilities reside across our structure, including Bermuda. We are often asked why we operate in Bermuda. The answer is simple. It provides access to third-party capital that supports growth and long-term commitments to policyholders. Importantly, Bermuda is recognized as reciprocal or equivalent jurisdiction by U.S. and European regulators. That means capital adequacy is measured through established risk-based capital frameworks, regulatory standards, and supervisory review by the Bermuda Monetary Authority. Reciprocity also means transparency, with Athene's primary U.S. regulator in Iowa maintaining full access to detailed reporting and oversight. Thanks in part to the investor capital we access in Bermuda, our policyholders benefit from the $37 billion of regulatory capital across our business and ample excess capital and liquidity supporting the promises we make to them. This policyholder-first mindset is embedded in Athene's culture of risk discipline, where risk management is embedded into every core function of the business. In the near term, we intend to publish our 8th annual asset stress test, a continuation of our regular IR programming. I'll now hand the call back to the operator and open up for any questions. Thank you.
Thank you. At this time, if you'd like to ask a question, please press star 1 on your phone keypad. If you wish to remove yourself from the queue, you may do so by pressing star 2. We remind you to please unmute your line when introduced, and if possible, pick up your handset for optimal sound quality. To ensure that everyone receives a turn, we ask that you please limit yourself to one question on the first go-around and hop back in the queue if you'd like to ask a follow-up. Our first question comes from the line of Peter Triosi with Barclays. Please proceed with your question.
Hi, good morning. You mentioned the large gain on the Intel Fabs asset in the quarter. So just curious if that gain was captured in the $877 million of SRE this quarter.
Right. Let me take that. This is LJ. So just a reminder, SRE is an accrual metric, and in some way, it's recognizing the running accrual value of assets net of cost of funds. So SRE, in effect, is removing out of GAAP earnings the volatility from unrealized assets carried at fair value into income and the asymmetric accounting we may have on the liability side. So SRE does not account for realized P&L and unrealized P&L. So in the case of Intel, to your question, the prepayment generated $700 million of gross GAAP income, but that did not flow into SRE. It, however, was accretive to capital. It was accretive to stat capital.
Yep, that makes sense. Makes the 22% increase in SRE this quarter even that stronger. My second question was just on ratings. I think that the management team has talked about getting second or third ratings on securities that only have, say, 1 or 2 ratings now. So can you talk a little bit about progress that you've made there?
It's a work in process. I mean, I think Jim mentioned the evolution of going from private to public on AMAPs, and we're in process in some of the larger private transactions, but I couldn't give you percentages.
Okay, thanks very much.
Thank you. Our next question comes from the line of Ryan Krueger with KBW. Please proceed with your question.
Hey, thanks. Good morning. I had a question about the retail annuity market. You pulled back some in the first quarter. I think you and others cited elevated competition. You definitely leaned in more in the second quarter. How would you characterize what led to the change in the attractiveness of the market from going from the first to the second quarter? Was it more changes in the competitive environment or better asset opportunities or maybe some combination?
Yeah, thanks, Ryan. I think it's the latter. It's some combination. We did launch some new products. We updated our RILA and that launched in the quarter. That was helpful. We brought out a new FIA in the IMO channel, Aviator, and that's off to a good start. We did have better asset opportunities, as Jim mentioned, where we think we're looking at a historic pipeline. So it was the case, and I think you need to be nuanced by channel, but we were much better positioned in the bank and the broker-dealer channel in the second quarter. Still the case that in the IMO channel, particularly in MYGAs in the IMO channel, it's extremely competitive, but we felt very good about our positioning across channels in the second quarter.
And just a quick follow-up on RILA. I think it's taken a while to gain more shelf space in that market, but you seem to be making a lot more progress now. I guess, what do you think is leading to that? Is it just the long kind of blocking and tackling of getting on the shelves, and do you see the momentum continuing from here?
I think it's some of that, and we do see the momentum continuing. We still need access to some of the bigger distribution outlets, and we've had a couple of big wins. They're not public yet, but we'll be going live in a couple of big distributors here in the next couple of months that we're very excited about. So, it sells primarily in the BD channel, and a lot of those relationships are relatively new for us. So you don't always start with your full product suite, but we got a lot of focus on RILA. We enhanced our wholesalers. We hired a number of new wholesalers at the beginning of the year to focus specifically on the BD channel, and I think all of those factors are paying off.
Great. Thank you.
Mm-hmm.
Thank you. Our next question comes from the line of Patrick Davitt with Autonomous Research. Please proceed with your question.
Hey, good morning. I think you stole my thunder a bit in your prepared remarks on this, but a prominent think this week about the big announced NVIDIA financing joint venture and is picking on you and Athene, Apollo and Athene specifically, and putting out a flow chart suggesting that Athene annuity holders will be financing all that risk through AMAPs. I think AMAPs is only 3% of your portfolio, so that alone suggests this argument is probably off base, but I'd be curious to get your thoughts on how much exposure to a deal like NVIDIA AMAPs could have, and then more broadly, take that as an opportunity to expand on how you're managing the broader exposure to data centers and the AI build-out, given Apollo is clearly planning to do a lot more there. Thank you.
I think, look, we've been pretty vocal about AMAPs is a CLO replacement. It's a better version of CLO. We talked about the metrics during my script. Thicker equity tranche, 85% investment grade compared to CLOs. So it's a better mousetrap. Look, we're proud to partner with Apollo on a lot of noteworthy, highly profiled, high publicity transactions. I mean, Athene has anchored multiple of those with Apollo this year, just to name a few: Paramount, Broadcom. We mentioned the commercial real estate from earlier, Lindy, Valor, Midcap. There's 2 large deals with our warehouse financing entity, Apollo's Atlas. These are noteworthy transactions in the news, and I mentioned the industrial renaissance. These are all consistent with being front and center in helping finance that. We're sticking to our metrics on AMAPs and the high quality collateral that it has, so I wouldn't be worried about any cross pollution on these. Plus, from what you just mentioned, we have guardrails in place for AMAPs. In working with our regulators, that's been a big issue for them as well. So there are guardrails in place that prohibit the creation of any direct or indirect circularity via the AMAP structure. For example, funds that have received investments from one AMAPs are not allowed to invest in any AMAPs vintages, as well as against cross-pollination, meaning one AMAPs is not allowed to invest in equity debt of another AMAPs. And we're partnered at the hip with the regulators on those safeguards.
I would just add, Patrick, I mean, we have single name limits for all issuers. And when you think about some of these AI infrastructure deals, the ones that we've been most prominent in are relatively short-term deals. A lot of them are taken directly, not through AMAPs. So yeah, I saw the chart you're referring to. I think it's a bit of hyperventilating and not really based in reality.
Thank you. Ladies and gentlemen, as a reminder, if you'd like to join the question queue, please press star 1 on your telephone keypad. Our next question comes from the line of Wilma Burdis with Raymond James. Please proceed with your question.
Hey, good morning. Could you talk about the fluctuation in other spread products, which went from $1.3 billion last quarter to $300 million this quarter, and what are the drivers there? Thanks.
Is that a reference to new markets? Look, it's just a new business. These are relatively newer businesses, startup in nature. I think you should expect that there'll be more volatility in volumes quarter to quarter as we kind of get those things up and running. But we said at the beginning of the year that we thought we'd generate $5 billion over the course of this year, and we still confident in that number. We did a big deal in the first quarter, which was a new transaction type for us in the stable value area, and it didn't replicate in the second quarter again. So there's just there'll be lumpiness as these things are getting up and running. We think things are going great. Really proud of how much progress we've made in the structured settlements area. I think we're sort of the second largest provider year to date there. So feeling good about the initiatives and thinking there's upside, but it'll be lumpy quarter to quarter.
Okay, thank you. And then this is sort of a broad question, but maybe you can talk a little bit about all that you published, the more recent just consolidated capital numbers across the entities, and there's been quite a few different short reports or whatever you want to call it that just discuss this topic. So just kind of curious, would love to hear an overview.
So we've been very transparent with respect to our excess capital and our RBC excess over 400 RBC. So I don't know if you make reference to the various texts that we published recently. I mean, we always lean towards more transparency and more focus into what we can provide publicly in terms of the asset tape, the details of our asset landscape, and where it's domiciled, either on IRS balance sheet or Bermuda. As it relates to our capital base, we have effectively a large excess capital base. We have capacity to redeploy. We tapped the market last week, as I said, to the tune of $1 billion, where initially the plan was considering $500 million. So that was an opportunistic move for us to pre-fund for growth for the remaining of the year and next year. I think we're in a very good place. Brent, you want to add anything?
That was it. Did that address your question, Wilma?
Yes, thank you.
Thank you. Our next question comes from the line of Tracy Benguigui with Wolfe Research. Please proceed with your question.
Thank you. Good morning. I would like to touch on your current risk transfer appetite. You've already done deals where you keep the investment in spread risk and retrocede the biometric risk. What is your appetite to apply that same approach to a long-term care block?
We've looked at it. We haven't looked at anything recently. The economics just haven't made sense to us. But if we could convert a long-term care block to something like a kind of known spread for a known period of time, we'd be willing to look at it. But it just hasn't been anything that made sense to us. We've seen some transactions occur in the marketplace, and we've looked at them. But I would say it fits in we look at everything inorganically, not just long-term care. We've looked at the universal life with secondary. We've looked at more exotic liability types. But it is the case, as it has been for quite some time, that we don't like the pricing at which inorganic deals are trading is below the price and the returns we can get on originating organic business, and that seems inverted to us. It seems like, because there's always unknowns when you do inorganic business, they ought to be underwritten to higher returns to account for the unknowns that you learn about after you own it. And that is not the current case in the inorganic space, which is why you see us not doing anything there. We look at everything, but we're not transacting because others are willing to pay higher prices.
Okay. And I'm curious then, what is the universe of reinsurers that may be willing to do these retrocessions?
That's not for me to comment on.
Okay. Thank you.
Thank you. Our next question comes from the line of Taylor Kramer with Aegon Asset Management. Please proceed with your question.
Hey, good morning. My first question was on the residential mortgage loan portfolio. It looked like there was some deterioration in the delinquencies and non-accruals. Just curious if you can comment on what's causing the increase, how widespread those issues are, and maybe if you can give some color on the average LTV of the troubled loans, that'd be helpful as well.
On some of the specifics, we probably have to get back to you on, but yeah, like we focus on it. We think we have a high quality portfolio. It's almost all RMLs, ones and twos. There have been some delinquencies, but in the scope of a $400+ billion balance sheet, that's to be expected, and a very small percentage of the total. So it's I don't think anything's changed. Our underwriting rigor is as has been, but there have been a couple missteps, but nothing sizable that would give us worry. So, but we can give you the precise LTVs of the problems offline.
Okay, that'd be helpful. Thanks. Next question was just on the office CRE exposure increasing again. Just curious, is this just driven by the RE transaction, or are you guys also looking to grow your office CRE exposure organically again? And if the latter, I'm just curious kind of what you're seeing that gives you comfort to kind of step back into the market.
Well, we're paid to look across sectors and see what's cheap, weigh in on things that are cheap and pretty protected. No, we don't have a concerted strategy to increase our office exposure. If there are one-off opportunities that we think make sense and we think that we're secured enough, then we'll be serious about it. But we're not trying to grow our office portfolio. And in fact, anytime we've done a deep underwriting position by position of our CML portfolio, one conclusion that we come to every single time is happy we're not in the equity. And that's still the case, but even in the debt on some of these office things we don't want. But when there's individual positions that can make sense for us, given some downside protection, then we'll look at it.
I appreciate that. Makes sense. Last question is just on the desire to get to the AA rating. I guess, what do you guys need to do to get there? Is it just simply about, a matter of time, or, I mean, do you need to make an acquisition to diversify your liabilities or geographic risk profile to get there? I guess, how do you think about kind of making that happen with an acquisition versus simply just kind of going about how you've been operating historically?
Yeah, Grant, I'll start with that one. Look, we've been running the company to at least AA standards for several years. So our desire to have AA rating is just get what we deserve. If you run the company to a certain standard, you should have that. Look, not having a AA from the three major rating agencies does not stop us from doing anything we want to do. But everything we do would probably be cheaper and easier with a AA. We consistently have AA or better capital levels, the most important single factor in the rating agencies. The thing that's holding us back is diversification. The rating agencies want us to diversify in businesses that we don't want to go into. But the prospects to grow our non-U.S. business, as we're doing in Japan, grow our exposure in Europe is a good thing for them, and new markets. As that grows, those are all diversifiers that the rating agencies welcome and would see as a real positive. But yeah, we're frustrated by not being AA when we think we should be right now. But we're going to keep at it because it's just want to get what we deserve.
Good. Thanks, Jim.
Thank you. Our next question comes from the line of Jason Domina with Longfellow Investment Management. Please proceed with your question.
Good morning. Thanks for taking my question. Appreciate it. I was hoping we could get an update as of the second quarter as to where levered lending is in the overall book, and if there are any plans potentially to report on a quarterly basis where private credit is within the Athene portfolio, as other competitors are doing. Thank you.
Well, levered lending, I mean, I'll just give you the stat. I mean, our high yield to invested assets percentage is, I don't know, 5 to 6%. So no change there. We're underweight high yield. We're underweight credit risk in general. Historically and even currently, we'd rather take, complexity and structure risk than more credit risk, and that remains the case today. And I don't see that changing anytime. So I don't think there's anything to report there. On the amount of private credit we have in the book, we could talk about. I don't know what we have posted on that, but our posting is the most transparent of any company in the business. So I think you can find what you need.
Yeah, I'll help out there, Jim. So we've said 20% is private credit. We've also said we wish we had more of it because those are the best origination that we get from Apollo. And as Jim mentioned, the impairments we've had on that portfolio are quite de minimis. So we report regularly on that. I don't know who you're referring to in terms of quarterly reporting, but I'm not aware of that. So be interested to know who you think's doing that.
Can I just remind the fact that in last quarter we published a full deck. We call that the Asset Compendium, which provides a deep dive and a full transparency on asset tape. So that's available, and we led the industry. I don't believe anybody has actually published this level of transparency.
Right. But no, I get all that. But that compendium was, those numbers, if I recall, was as of year-end 25. And there are several competitors that are producing, where their levels are each quarter. So that my only question is really, would you do it regularly each quarter as to where those levels are? That's really just all the question's about.
We'll take it under advisement. I don't know what our plan is. I mean, I would imagine that as we've done with other decks that we've put out, we've tended to update them annually. I don't know that we're going to go to a quarterly format.
Thank you. Our next question comes from the line of Steve Sun with JP Morgan. Please proceed with your question.
Hi, good morning, and thanks for taking my question. My first question, just a little bit more detail on your AMAPs investments, and what is your total investment so far? And do you guys only invest in the highest tranche, the A tranche, or do you also invest in the Bs and the Cs? And any color there would be helpful. Thanks.
Sure. Athene's AMAPs exposure as of June 30th is $13 billion on a gross basis, $10 billion on a net basis. With each AMAPs vintage, Athene invests less and syndicates more. Third-party capital is a key ingredient in our strategy, and it reflects the demand for the same assets we're buying by others. And again, AMAPs are our CLO replacement strategy, and you'll see our AMAPs investments grow over time, but in a prudent way. And essentially, it's all investment grade. When there's the equity or even non-investment grade pieces of those, that typically would reside in our AAA entity, Apollo Aligned Alternative, which is close to half owned by third parties.
So which means that you also invest down to the B tranche, from what you're saying, not just limited to the A tranche. The B tranche is still AAA rated, it's still investment grade.
Yeah. The bulk of most everything that Athene's buying is investment grade on the AMAPs, but there are smaller slivers of non-investment grade and/or equity, and when placing those would be AAA. Our entity that houses our alternatives would be the buyer of those if we decided to do that.
And 75% of the AMAP structure is the A-rated tranche.
So are you buying just in proportional to that 75%?
No, we don't buy the full A tranche. That's the question.
No, we're not buying the full. I'm just saying of the capital stack, we're overwhelmingly in the A tranche because it's 75% of the capital stack.
Okay,
but we're not necessarily buying a vertical strip of the capital structure either.
Okay.
What Jim's saying is we have some de minimis exposure to the equity because AAA buys the equity and we own roughly half of AAA. So on a look-through basis, we have some exposure to the equity, but Athene is buying primarily the A tranche and the BBB tranche.
Okay, thanks. My second question is on your funding liability side, really on your funding agreement backed repo, which are backed by collateral. So you mentioned that, you guys put the policyholder interest at top, look at the safety, but how do you address the criticism, your FABR are backed by collaterals, so those collaterals basically sit higher than the policyholders. If you're in trouble, the policyholders really have no access. And so basically policyholders are subordinated. So how do you address that criticism?
Policyholders subordinated to whom?
Backed repo, which are collateralized. So if you are in trouble, those collaterals belong to the counterparties of funding agreement backed repo counterparties. They don't belong to the policyholders. The policyholders have no access to that collateral if you're in trouble, of course.
We conduct cash flow testing as required by the regulators for every legal entity on a quarterly basis. It excludes anything that's pledged. It assumes we actually have no equity. So it just looks at the cash flow of our assets, unencumbered assets, and says, can we pay off all liabilities in various interest rate scenarios? And we pass every scenario in every legal entity every quarter. Right, Mark? By quite a bit of margin.
Thank you. Our next question comes from the line of Chad Stogel with Spectrum. Please proceed with your question.
Hi, thanks for the call and the question. First, just a clarification on the page 12 of the supplement. You show some of the asset mix in the alternatives bucket, and noticed that the equity piece has gone up. It's not a material number relative to your overall sheet, but just that it's gone up materially. Is that AMAPs related?
No, it's not. I can take that. So maybe just to put in relative terms, the performance in the quarter, Athene's alts return was 9% annualized on the quarter, and that compares to a shy 7% for the rest of the peers, and some of those are laggers. And if you recall, alternatives really represent 5% of Athene's portfolio, and it's mostly senior secured private credit and origination platforms, so not equity beta. And those investments are very well diversified, so very, very well diversified portfolio, both the vast majority of which sits in AAA, where we have very material third-party investors. The rest of that portfolio is Athene is Athene invested into what we call retirement services platforms, of which we have Venerable and Athora to just name two. So the AAA actually has produced in Q2 roughly 11% and is bang on our long-term benchmark. And going forward, what we see is some further gains in organic growth and returns at Athora as the peak integration progresses and the asset portfolio is optimized. So we reaffirm effectively our long-term view of 11% as being a reasonable normalized assumption. And that's effectively the way we look at this alts portfolio.
And within that, I just see structured equity and other jump from year-end from about 7% to 20%. That just so I can classify what that refers to within that investment.
Yeah, that's the increase in Athora. That's pretty much all it is.
Oh, okay. Got it. Okay. And then just within AMAPs, when you on the slide deck that you provided a few months ago, there was a comparison, obviously, to CLOs and the advantages. When you reference that a vast majority or a significant amount of AMAPs is truly investment grade exposure within the structure, what are some examples of those investment grade assets that sit within the AMAPs vehicle?
We can get back to you with specific examples of some of the underlying credits, if that's what you're asking.
Helpful. And then just last on that, since it's related, you mentioned you don't necessarily take a vertical slice. Who are typically the buyers of the equity? You said that would be syndicated. Who would be the largest buyers of the residual piece of something like AMAPs?
Existing LPs of Apollo. We haven't disclosed who the buyers are. It's existing Apollo relationships.
Thank you.
Hey, I just wanted to expand on, there was a question earlier about levered lending, and I mentioned our non-investment grade asset exposure in general, which I said was 5 or 6%, but on specifically levered lending, we have 40 basis points of exposure to levered lending, and software levered lending is 10 basis points of exposure. So de minimis, very low. Just wanted to make sure that's answered on point. Sorry, go ahead, operator.
Sorry. Our final question comes from the line of Patrick Davitt with Autonomous Research. Please proceed with your question.
Hey, thanks for the follow-up. Sorry if I missed this early, but I think in the past you have given a quarter-to-date organic flow number. Are you willing to do that today?
I don't have it off the top of my head. I would say the quarter is going reasonably well. Still seeing good flows in retail, but I don't have that number off the top of my head. I would say we're expecting, we're about halfway through the year, and obviously we're about halfway to that $85 billion number. Still confident that we're going to get there, and still seeing retail strength in the third quarter.
If I could throw a quick follow-up, then there was some current concern last week on your relationship with FWD, given news that China was cracking down on the use of foreign annuity products. Did you address any exposure to that issue, either through your equity position, FWD, and/or annuity flow agreements with FWD?
It's not an issue for us. I mean, as I understand that, it's primarily inside China. We don't operate inside China. The relationship we have with FWD is kind of across the region, but the reinsurance deal we did with them was in Japan.
Right. Okay. Thanks, guys.
Thank you. Ladies and gentlemen, that concludes the question and answer portion of today's call. I'll now turn the floor back to Jeannie Hess for any additional or closing comments.
Thanks, Melissa, and thanks everyone for joining us for today's call. If you have any follow-up questions, please don't hesitate to reach out.
Thank you. This does conclude Athene's Fixed Income Investor Call. Please disconnect your lines at this time